Assalamu alaikum, ladies and gentlemen, esteemed guests, excellencies. Welcome to the Oman Capital Market Conference, second edition, under the title, From Resilience to Growth. This event is being presented under the patronage of His Excellency Engineer Salim bin Nasser Al-Ofi, Minister of Energy and Minerals, to whom we are very grateful. My name is Michael Grifferty, President of the Gulf Capital Market Association, the financial industry association that promotes the region's rapidly evolving capital markets. We are excited to present today's conference as it falls at a critical inflection point for the region's markets, and in particular for the Sultanate of Oman. I will be your MC for the course of the event, and so it falls to me to mention a couple of brief housekeeping notes and reminders. Kindly keep cell phones to silent mode, and if you have important matters to discuss, please take those conversations outside. I would also like to remind you that today's proceedings are being live streamed to a wide audience. Importantly, I would like to thank our valued partners, State Street, in particular Faisal Al-Nabhani, and the Muscat Stock Exchange, for their hard work and cooperation in preparing today's event. It's my honor now to invite to the stage the conference chair, Faisal Al-Nabhani, Managing Director and Country Lead for Oman and Qatar at State Street. Faisal.
Thank you very much, Michael. Good morning, everyone. Distinguished guests, honored officials, regulators, and colleagues. It is a privilege to welcome you to the second edition of the Oman Capital Market Conference and to see so many leaders gathered here in Muscat. Allow me please to extend a very special welcome to our guest of honor, His Excellency Engineer Salim bin Nasser Al-Ofi, Minister of Energy and Minerals. Your presence today reflects the importance of this platform and the connection between national ambition, energy, leadership, and capital market development. We meet at a consequential moment for our region. In recent months, geopolitical tensions in the Gulf have reminded us how closely stability, trade, and financial systems are linked. These developments have tested confidence, disrupted flows, and sharpened the focus on resilience. Yet, as we begin to see progress toward the reopening of key trade routes, there is a renewed sense of momentum, one grounded not in assumption, but in the strength of institutions and the value of cooperation. That is precisely why this conference matters. Last year's inaugural edition laid the foundation, bringing together policymakers, regulators, investors, and market participants to begin a shared conversation about the future of Oman's capital market. This second edition builds on that progress. It reflects a growing recognition that Oman's capital markets are not only becoming more resilient, but increasingly relevant within the regional and global investment landscape. For our part, this conference reflects a broader commitment. Meaningful investment in any market goes beyond capital. It requires presence, partnership, and a long-term perspective. When we established our office here just over 2 years ago, we did so because we believed in Oman's direction of travel and in the opportunity to support the continued development of its financial ecosystem, aligned with Oman Vision 2040. As one of the first global custody institutions to establish a presence in the Sultanate, we recognized early what continues to define Oman today: clarity of vision, institutional strength, and a disciplined approach to reform. These are the fundamentals that matter, because capital ultimately flows where there is trust, consistency, and confidence in how markets operate, particularly in periods of uncertainty. That brings us to today's agenda. We begin with the Muscat Leadership Dialogue, which will bring together senior voices to examine the global and regional forces shaping capital allocation, economic policy, and investor confidence. We will then turn to explore two defining themes. First, the global energy debate, a topic of central importance, where energy security, transition, and competitiveness must be considered together, particularly for this region. And second, Oman's journey toward emerging market status. This is not simply a milestone. It is a signal of progress in market access, governance, liquidity, and transparency. It also brings with it higher expectations that markets operate efficiently, consistently, and at a level that global investors can rely on. These topics are not theoretical. They are about how capital moves, how risk is managed, and how confidence is earned and sustained over time. Oman approaches this from a position of strength. It has a clear national vision, a strategic geographic location, and a reform agenda that continues to build credibility with investors. At the same time, its role within the wider GCC is increasingly important. The region's competitiveness will be shaped not only by individual markets, but by how effectively they connect, complement one another, and collectively attract global capital. In periods of uncertainty, leadership matters most, not just in setting direction, but in maintaining focus and consistency over time. Oman has demonstrated this through steady reform, constructive dialogue, and a long-term commitment to economic development under the leadership of His Majesty Sultan Haytham bin Tariq. On behalf of the conference partners and organizers, I would like to thank all of you for being here today and for contributing your insight and experience to these discussions. I would also like to thank our co-organizers, Muscat Bors and GCMA, and in particular Mohammed Al-Ardi, Haytham Al-Salmi, and Michael Grifferty, along with their teams for their continued support and dedication. I encourage you to use today to engage openly, challenge constructively, and build the partnerships that will help shape the next phase of Oman's capital markets. With that, and with the permission of our guest of honor, it is my pleasure to formally open the second edition of the Oman Capital Market Conference. I thank you.
Thank you very much, Faisal, for opening the conference. May I invite to the stage, please, Haytham bin Salam Al-Salmi, CEO of the Muscat Stock Exchange.
Bismillah ar-Rahman ar-Rahim. Your Excellency, Sanem bin Nasser Al-Aufi, Your Excellencies, ladies and gentlemen, distinguished guests, and esteemed colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. It's my honor to welcome you all to this important gathering, where we reflect the journey of our regional capital markets and chart a path forward. The title of our conference, From Resilience to Growth, captures the essence of our collective experience. The knocks, the disruption that's happening around us shows that it just brings our attention, but it never stops us forward. So we have seen a very challenging situations all over the past 5 years in a very disruptive geopolitical area around us. But the past few years just proved to us that the complex geopolitical conditions just tested the strength of our economies and the adaptability of our financial systems. Oman itself has demonstrated a remarkable resilience through prudent fiscal management, diversification strategies, and a commitment to reform. The Sultanate has not just only weathered global challenges, but has emerged stronger, with renewed confidence in its economic trajectory. The resilience is mirrored across the GCC. In 2025, our capital market achieved significant milestones. Debt market expanded to 1.1 trillion US dollars, while equity market surpassed 600 billion in capitalization. IPO activity was vibrant, with the GCC contributing more than 5% of the global deal value, underscoring the regional transformation into a mainstream investment destination. Across the GCC exchanges, 2025 performance was diverse. Saudi Arabia Tadawul, the largest exchange, declined by 12.8%, but remained the most active in listing, with over 40 IPOs, including Flying Ass raising 1.1 billion US dollars. Dubai rose 17.2%, Abu Dhabi gained 6.1%, Kuwait surged 21.2%, while Qatar and Bahrain posted modest growth of 1.8 and 4.1 respectively. Oman's Muscat Stock Exchange stood out as a regional top performer in 2025, advancing by 28.2% growth, with a steady trading volume growth year to date. Though smaller in scale, Oman Exchange demonstrated disciplined resilience and investors' confidence, positioned itself as a dynamic market within the GCC exchanges. Over the past 5 years, Oman trading values have grown dramatically from an average of just 1.8 million Omani riyals daily in 2020 to over 60 million Omani riyals daily year to date. This is nearly 30-fold increase, reflects stronger investors' participation, improved liquidity, and a reform that has enhanced transparency and market depth. It underscores how Oman, while modest in size compared to Tadawul or ADX, has become one of the fastest improving exchanges in the GCC and in the world. Taking a holistic view, Oman's broader economic progress reinforces this momentum. According to IMF, the Sultanate recorded a GDP growth of 2.3% in 2025, with inflation contained at lower than 1%, a fiscal surplus of 0.7% of GDP, and a current amount surplus of 1.3% of GDP. Government debt was reduced to less than 36% of GDP, reflecting a fiscal discipline and reforms. Compared to GCC averages, while the overall GDP growth was around 4% and inflation closer to 2%, Oman's indicators highlight stability, prudent management, and steady path of diversification under Oman Vision 2040. This progress is not just about numbers, it is about building a future while capital markets serve as engine of opportunities, connecting local enterprises with global investors, and ensuring that Oman's economic development is inclusive, diversified, and forward-looking. And with fiscal surplus, low inflations, and steady raising trading volumes, reinforces investor confidence. Oman's capital markets are positioned as a trusted gateway for regional and global investments. As we embark on today's discussions, let us celebrate the resilience that has been brought us here and focus on the strategies that will drive our growth in the years ahead. Together, we can shape capital markets that are not only robust in the face of uncertainty, but also vibrant platforms for innovation, prosperity, and regional leadership. Thank you all, and I wish you all productive and inspiring conference.
Thank you so much. I would like to direct your attention to the center stage now, where something special will take place. For the first time, we're presenting, as Faisal has mentioned, the Muscat Leadership Dialogue. This is a new forum that gathers visionary leaders in a cross-sectoral, cross-disciplinary way to debate key global, regional, and national developments with an Oman perspective. Faisal Al-Nabhani will lead the discussion, which I think you'll find very interesting. Faisal?
Can you hear me? Okay. So, as Michael said, this is our flagship event in this morning. We are greatly looking forward to discussing some topical, very important topics. To help me with this, I'd like to welcome to the stage the panelists who I am sure will contribute immensely to enriching the discussion. His Excellency Munir Al-Muniri, Deputy President for Operations, Oman Investment Authority. Haytham Al-Salmi, CEO, Muscat Stock Exchange. Mr. Tariq Al-Sudairi, CEO of Jadwa. Mr. Muhammad Ismail Imadi, Group CEO of Lisha Bank. And Mr. Mark Elliott, Head of Eastern Arabia, MasterCard. Please. So welcome to the panel. Thank you very much for taking the time and for coming from as far away as Saudi Arabia and as Qatar to join us in what I hope will be what I'm sure will be an excellent discussion. I know that Michael was building up the suspense, and we fully intend to ask all the questions that our audience and our viewers on the live stream would like to be answered. You will see that these days there's a lot of uncertainty, right, in the region over the past few months, and the Gulf region specifically, which sits at the crossroads of global trade and energy flows, remains one of the most critical arteries. And so, alongside these challenges, there is an extraordinary opportunity to deepen resilience and mobilize investment, and to chart a path towards sustainable growth. And that's why we've really gathered together this group of very insightful panelists who are all leaders in their respective fields, for us really to get a sense of where we are at the moment and where things will go from now onwards. And if you allow me, I think I'm going to start with Haytham, because Haytham represents the Muscat Bourse, and he's a co-organizer. So if you allow me, His Excellency, Haytham will be the first one. And this round, we'll make it an easy one. No kind of thing. We're going to just ask generally. I heard in your speech, you talked about how Muscat Stock Exchange was one of the top performing stock markets in the region. Can you please tell us what has led to that in your opinion? And what kind of reforms did Muscat Stock Exchange work on?
We start.
No, I think there's a mic.
I can. Yeah.
Now it's working. It's working.
I thought I would start screaming, but
No,
it's working well.
don't, please don't.
So Muscat Stock Exchange has a very good components in terms of the listed companies. A very good performing listed companies in terms of fundamentals and in terms of dividends. And we have been known as a dividend yield market for a very long time. And the main obstacle toward, I would say, recognizing the value of the stocks and the value of the companies is liquidity. The lack of liquidity really pushes the prices to remain at a lower level and never reflects on the positive news, positive performance of the companies. So the main focus when we put the strategy of our Muscat Stock Exchange, we put in the center of the strategy is to upgrade the market to be an emerging market. Why we kept this as a central of the strategy? Because we understand moving toward that direction will let us fix all what is required to achieve a higher liquidity and a higher market cap. So we did the reforms as much as we can in terms of taking the hanging fruits. First of all, removing the barriers of entry for all investors by removing the ceilings for foreign ownership, and that itself has increased the investable cap in MSX by 70%. And then focused in introducing liquidity providers where the issuers appoint liquidity providers. And that was the first stage to fill the order books. And then worked with the main investors in the market, Oman Investment Authority and the SPF, the pension fund, to enhance the free float in the market.
Thank you. Thank you.
So along with that, with the IPOs that came from the government, the divestment plan has enriched the market and has created an attraction to Oman. It has been complemented by our focused roadshows and marketing, where we met investors. It's not just meeting the investors. I met myself with members, brokers worldwide, just to bring attention to Oman and put Oman in the international radar. It has resulted well, where the volumes has increased, and it allowed the stocks and the listed instruments to gain back their value. Comparing the yield that started at over 8% an average of most of the listed stocks, where the other GCC markets offers an average of 3.8 to 4%.
Right.
So that gap was that big.
We will also get to that in a bit, the different yields and how they performed in the past few months. But before we get to that, you mentioned OIA being one of the main drivers for developing the local stock market. And I think it's a good segue to ask you, Your Excellency, if I may, as the Deputy President for Operations of our Sovereign Wealth Fund, what is and what has OIA in terms of its divestment plan? How has that helped develop the Muscat Stock Exchange and provide that much needed liquidity in its journey towards achieving emerging market status?
First, I would like to thank you, Faisal, for the invitation, and it's my pleasure to be along my colleagues here in this panel. I'm not sure if I'll be able to say smart answers as they would say, but it's a pleasure, and صباح الخير جميعا. Basically, let me take you one step back. I think OIA, through the Royal Decree in 2021, been appointed as the shareholder of MSX by then. And therefore, what OIA managed to do is to put the full strategy for the MSX that included, of course, how we can transform the stock exchange from what was before into a stock exchange that is more attractive for international investors along with the local investors, and definitely as a source of capital that investors will tap into when they look at MSX. And that strategy also allowed us to put the right operating model, put the right human capital, governance, that built the story behind the MSX that we see today. The second pillar that we focused on was also the divestment plan, which basically OIA had in mind since it started in 2020. We have a portfolio of more than, I would say, 250 companies locally. Some of them active, some of them passive, but ultimately it's a huge market player that actually through it we wanted to contribute to the MSX story. And our divestment plan from 2021 till today actually allowed us to exit around 24 companies, 6 of them through IPOs. We managed to bring diversity to MSX through these IPOs. We were first, we listed basically 2 companies or 3 companies in the oil and gas sector. OQEP, OQ Gas Network, Apraj. Those are all critical in the story today of bringing diversity in MSX. Before that, Oman is, of course, Oman's economy is based on oil and gas, and as we understand, and there was no representation in MSX. Now we have good, basically 3 companies that represent that sector, of course, and also when it comes to transportation and shipping and logistics, Asia Shipping was also another story, and bring diversity when it comes to the blue chip stocks that can be traded in MSX. And that story will continue. It will not stop. And of course, our third focus was to bring liquidity to the market, where we worked closely with our local partners, SPF, and other stakeholders within the market to develop this through tools that will allow us to basically bring liquidity. And we can see today from the numbers that Haytham just mentioned. And finally, of course, we used our international network to market MSX, talk to our partners internationally, the partners that we use usually in our investments internationally, like the asset managers and the rest. Right. And we were successful, alhamdulillah, as we see today that the interest is much bigger in MSX, and we are on the way, inshallah, to be upgraded to emerging markets soon.
Excellent. And we're all looking forward to that. And there's good news in that, and we'll explore that in some detail as well in the third panel session today that my colleague George Hanna will be moderating. But let's now move, if I may, to Tariq Sderi. Tariq Sderi, you are you're not just the head of one of the largest asset managers and financial advisories in the Gulf, headquartered in Saudi. You are also one of the shapers, as well as my colleagues on the panel, in terms of capital markets and the financial ecosystem. And I have many questions to ask, but let me just start, if I may, to get what's your views in terms of where capital flows in this uncertain environment should go? From your vantage point, given where we are today, what are the focus areas? What's Jadwa what's the thinking behind Jadwa's investments recently?
Thank you, Faisal, for the invitation. It's a great pleasure to be with you. I think when I look at capital flows in the region, a couple of thoughts come to mind. The first is the GCC collectively has embarked on an ambitious economic transformation program that includes a broad range of economic reforms and large-scale investments. I think this has effectively transformed the GCC from being a net exporter of capital to being a net importer of capital. And I think within that context, the capital markets in the GCC and the investment management industry will play a central role in attracting, structuring, and effectively allocating that capital into the most impactful deployment. I think the second thought that comes to mind is the recent conflict in the region has a couple of important implications. One is, I believe that today the name of the game for the GCC is geoeconomic resilience. I think what that means is you'll see a push across the GCC to localize critical industries, to invest in infrastructure redundancies in terms of energy, in terms of logistics, supply chains, ports, transportation, that will require significant deployment of capital domestically. The second implication is, I think, foreign capital will find it difficult to compete for these investment opportunities because of what they will associate with the region as a higher risk premium. That effectively means that there are significant investment opportunities where domestic and regional capital will have a competitive advantage in capturing these opportunities. So my expectation is you'll see increased investments, you will see increased allocation from regional investors into the region. And the early indications we're seeing from our own clients is actually quite consistent with that. We are seeing reshoring of capital in preparation for these investment opportunities.
Thank you very much. Mohammed Al-Umadi, you are the Group CEO of Lisha Bank. Lisha used to be known as Qatar First Bank and rebranded 5 years ago. And you have grown on an average, I believe, by 45% year on year, which is really remarkable. The first investment bank registered on the Qatari Stock Exchange. So you also have a very good view in terms of investments going forward, especially Sharia-compliant investments, which I understand is a specialty of Lisha Bank. Where do you see things going?
First, thank you, Faisal, for inviting me here, and it's a pleasure to be in Sultanate Oman with friends and colleagues. So, as my colleague Tariq mentioned, the conflict had shown how the GCC is playing a very important role in the energy market globally, where 20% of energy does travel through the Strait of Hormuz, which have created a disruption overall in the global market. And this shows how important is this region and how deep it is in terms of importance in terms of investment as well. You see people from the region and outside now seeing the region differently in terms of how deep the sovereign balance sheet in this region and how can be also resilient, because conflict or disruption can come and go, this is the time where the opportunity it really comes. If you see today the behavior of high net worth individuals, where they are used to invest or to diversify on the global market, now taking also a position on the GCC area to diversify their capital. Despite the conflict, and they see the opportunity where it is. Yes, we are seeing some liquidity is flowing, but this is a matter of reallocation in terms of to diversify as well as to change in terms of asset class. At this time, people look on different ways of investment or different classes of investment. They think about liquidity, they think about visibility of cash flow, they think about protection, downside protection. So these elements is very important for capital preservations, which is important at this time where investors are looking at it.
So it's a reallocation based on asset class, not based on geography.
Geography is important in the diversification. However, where we see there is a different allocation in the asset class rather than geography. And this is the understanding that from all international investors are having, where they need to have a clarity on how cash flow is coming.
That's great. And finally, for this first round, before we move and turn the heat up a little, we will go to you, Mark Elliott. You are head of East Arabia with MasterCard. This in itself, East Arabia, I think is something my colleagues should take note of. I haven't heard that one before, but that's MasterCard, leaders not just in their respective field, but also in organizing themselves. And I think what I'd really like to ask you, if I may, we've heard from asset owners and asset managers, sovereigns, and the stock exchange. What we're missing is to understand a little bit more about consumers. How are consumers spending? How is the behavior changing? Is it changing at all? And who better to answer that than MasterCard? So the floor is yours, sir.
Thank you, Faisal, and thanks very much for the invitation to this distinguished panel. I think it's fair to say that behavior is adapting. I think we can all see that flight capacity is probably down about 25%. You know, the large-scale events which we used to see from corporates are not happening like they used to in the Middle East. The big crypto conferences and these types of things have slowed down. And discretionary spend on T&E is reduced. Having said that, you know, when we think about the consumer, yeah, probably inbound is reduced from a tourism standpoint, but that's because insurance is harder to come by in a force majeure type event. That's just the reality. But in Oman, I think you know, it has been a story like that. And then around the region, we've seen slightly different stories. So in Saudi, for example, the religious holiday corridor has continued to thrive, you know, like it does every year, which I think is a very reasonable expectation. I think the big story, though, in Oman, from the data, from what we're seeing at the moment, is the non-oil growth. So non-oil is up 3% in 2025, and just breaking that down across the different sectors, services up 3.4%, F&B up 13.8%, telco up 8.5%, and financial services up 6.3%. So the non-oil story continues to be something as part of this adaptation, which I think is something to focus on, underpin, and support.
Excellent. It was great to see that trend. So now we're going to use the high tech to bring in one of our colleagues who couldn't make it, who is our top geopolitics expert within State Street. And we cannot have a conversation on capital markets and capital flows anymore without appreciating geopolitics. Geopolitics has become part and parcel of this entire mix. And we really need to understand and appreciate not just how things stand today, but how things are likely to develop so that our clients and our stakeholders are prepared and have the correct resilience measures in place. And to help with that, we have Elliot Hentov, who is our geopolitics expert on the video. If colleagues can please play back video number 1, that would be great. Let's take a listen.
Where's the Gulf today? We had the worst case scenario materialize. A full-on regional war. Missiles and drones flying across all countries, hitting civilian infrastructure, hitting energy facilities, and hitting other targets. And how has the Gulf fared? We have to be honest, relatively well. Human losses, thankfully, have been kept to a minimum, and a lot of the emergency measures have performed exactly as planned. For example, oil bypass routes in Saudi Arabia and the United Arab Emirates have been maximized to their full potential. Financial measures, liquidity provision, reserve buffers have performed exactly as planned for this emergency. This is not only my opinion, this is the opinion of local equity markets too. If you stand from a distance and look at the charts, you would barely see that a regional conflict took place at all.
So you've heard Elliot. He talked about how, despite all the conflict that took place, we are still in the Gulf quite resilient in terms of our capital markets. And on the screen, there's a graph that I would quite like to pick your brains on in terms of the performance of these countries. That graph basically illustrates the performance of the 6 GCC countries since the start of the conflict as of the 22nd of May. And you will see there is positive growth for Saudi and Oman, and there's a little bit of a decline, UAE and Bahrain and Qatar. But even that decline was not seismic. I think that's the point that Elliot referred to. And so I want to really hear your thoughts about why you think that is. Is the reason that governments in the GCC injected more liquidity in the markets for resilience projects? Is that why? Is there some other reason? Any takers?
I think
Haytham.
if you allow me to start, one of the main, I would say, drivers is the percentage of foreign ownership, because in terms when the war started, then the first movers out will be foreign investors. And taking into consideration that the amount of foreign investment in the UAE, for example, and then Qatar is higher than Oman, that's one of the main drivers where we can see a reflection on what happened. Another one driver is the performance of 2025 until, I would say, March of the markets. Most of the positive markets who done very well back in 2028 got the maximum crash, which is, again, UAE, where Saudi was negative, highly negative, I would say, the most impacted market during 2025. So this could be one of the main reasons. The inflows and outflows of foreign investors, how much is the foreign investments overall. And one of the main drivers that allowed as well MSX to sustain is the, comparing to GCC, we have the highest contribution of institutional investors, more than 75%, who are mainly not speculators rather than long-term investors.
Thanks for that. And in terms of, Your Excellency, in terms of OIA, how do you see these tensions influencing capital allocation? Are we going to be looking at more inward investment for resilience, or is that not really going to change much in terms of the allocation policy?
I think, yeah, I mean, Oman has is blessed by a strategic location today that is becoming more valuable going forward due to where we stand as outside the state of Hormuz. And we have very strong infrastructure available in Sohar and Duqm and Salalah. Connectivity is there. And even lately with the issues that we had, Asyad Shipping was able to basically build more connectivities. And also we've seen more shipping lines coming to start operating from Oman. Ultimately, that itself helped us in also building some of the resilience that we have. Definitely, there are discussions with other countries within the region to see how we can capitalize on this more. It's not only about connectivity in terms of products and logistically selling whatever we can sell through Oman, but also we're talking about oil pipelines, probably, maybe we can talk about digital infrastructure connectivity, where today we also are blessed by basically having 24, I think, submarine cables landing in Oman. So the digital infrastructure story can be really redesigned to include Oman as part of the region's resilience. So the story is there. I think it's all about the timing. I think whenever it's the countries are ready, I think we can definitely develop this. We've seen also some of the international companies and regional companies talking about storage facilities when it comes to oil tanks and the rest and Duqm. So again, I think the infrastructure is ready, story is there. It's about capitalizing on this, and it's about initiating this further. And we can have definitely, as collectively as a region, a stronger resilience story going forward, which actually we are today here in Oman standing and saying, happy to support by all means at the right time that our partners see for them is the right time.
And it's a complementarity more than anything else, in a sense that how the various GCC countries are able to complement one another to enhance that overall resilience and to make sure that these capital markets continue to thrive and prosper despite being under extreme circumstances, really, which for me is quite an important aspect.
Definitely, I think that is the story here. We work as brothers, and definitely it's a work important. How do we see this? That we want to make sure that it's a story that will make us stronger after this. So ultimately, at the right time, we can contribute further in developing the story of connectivity.
Thanks, Your Excellency.
It's one of the good things to mention over here. I will echo what His Excellency Abdulsalam al-Murshidi mentioned in the press release when they have OIA conference, that there was a focus on scalability rather than really focus on having a temporary gains from the situation. So embarking onto what this conditions has brought us as a learning and opportunities, and leveraging on the opportunities to increase scales, to increase without really impacting the prices or really using the situation to get very short gains. And that itself create more resilience.
But is this scalability, Haytham, and are these adjustments, are they temporary to respond to a specific circumstance and then they'd go away? Or are they permanent, do you feel, and need to be factored in?
There are two ways to look into that. Whether we focus on the price differences that has been created because of the situation that will never sustain, or we leverage on the opportunity and make sure that this opportunity remains with Oman being a very strategic location and build on it. So we keep the story on instead of just leveraging on the price and gain short term.
That's interesting. And adjustments are necessary in these times. And maybe we can go to Muhammad Al-Imadi, and maybe if you can sort of hone into a specific area so that we can understand better how some of these adjustments and risk hedging measures can take place to enhance resilience. Specifically in the area of aviation. I know that Lisha Bank is a market leader in investing into aviation. What kind, and obviously the oil price has increased as a result of the conflict, so there must be an impact, and I think, Mark, you mentioned briefly how there's an impact on tourism and travel. So from an investor standpoint, what are the risks there, and what are you doing about it?
Sure. So aviation, on the spectrum of aviation, there is many area of investments. Can be aircraft leasing, it can be airports, can be MROs, which is maintenance centers. So there is many area of investment in the aviation spectrum. If you look at the airlines, which is mainly the heavily impacted on what's happening in the current conflict, you see oil prices has shooted up. So jet fuel almost double in terms of cost. Insurance cost also had risen. Routes have been cancelled. So many sort of extreme disruption actually happened in terms of the airlines. Adding on that, also some of the airlines having difficulty in terms of providing the physical jet fuel, so they had to cancel some routes due to these issues. Usually, cost of fuel in the airlines between 30 to 40%. Which is, will impact the overall cost of airlines. Here where we see the management of airlines or the ownership of airlines or the overall credit of the airlines is the back support for these financial aspects. If you see the region, majority of these airlines are backed by sovereigns, so they have a very strong backups, they have a strong cash position, so the ability for them to sustain over this time, they will be able to sustain and they will be able to fulfill their commitments if they are in the aircraft leasing or if they have been leasing aircrafts or if they want to manage any disruption and that sort. If you go to some other airlines, which is on the taking, the full market risk, is depend on the management. You see, some of the airlines are hedging themselves in terms of fuel. They hedge for about 70 to 80% of their fuel consumption to be able to sell tickets on advance. So this management of airlines shows how they can be risk the risk management is mitigated as well as to be well managed.
But can I push back on,
Sure.
on some, because I'm going to try and turn the heat up a little bit as well, with your permission. One thing is risk management, but what do you say to the notion that the risk here is that there's not enough oil to go around? There's not enough, because of what's going on. A lot of the oil supply is currently being inhibited. Oil flows are inhibited. So it's not just a question of clever ways to hedge against risks, but it's just there's not enough in supply. What do you say to that?
See, at the beginning of the conflict, where majority of the corridors of flying was really shut down, and this is where putting lots of pressure in some routes that is not related to the GCC, for example, Turkey, for example, some part of Europe. This is where shortage of jet fuel was there. However, now, when the routes are open back to not normal, I would say, to half normal, okay, things are a little bit easier. We are still not back to fully operational on the aviation aspects due to disruption in terms of corridors to travel in, where there is still a sort of precautions there. So things is getting easier, but tickets have been actually raised in some area. We see some support from regional airlines to get back traffic, to ensure that normalization is happening.
Right.
So disruption is there, the effect is there. The approach that we take in terms of leasing is a long-term approach where contracts are in a longer term. We care about credit of the airlines, so this is very important for us. Taking positions in airports also is very important, where we see a strategic area as well.
So cautious optimism, that's the message. Yeah. Despite all the challenges from both ways, from oil supply as well as consumer appetite, despite that, cautious optimism. Let's move to Tariq. And if I may, Tariq, when I ask you, I always like to know your opinions about capital flows, because you get to see them and you're able to give us good insights on this. Is defense spending going to increase in the region? And are some capital flows and asset allocations going to go to defense?
Yes. Yes, I think so. And when I look at, because we manage investments across all major asset classes, both within the region and outside the region. And so that gives us a useful perspective on how investors are reacting, what they're seeing, and how they're positioning themselves. And clearly, defense and infrastructure now has been reprioritized as the key thing to focus on, how to be better prepared and more resilient in the face of future flare-ups or conflicts. So within that context, when I look at our clients, what they're thinking about, I see a couple of themes. One is capital reshoring from abroad back into the region in preparation for these expected investment opportunities. And so you'll expect more of these investments to be offered. I think you'll see accelerated privatization push in these industries, potentially greater infrastructure integration within the region to facilitate alternative supply chain routes, whether through the Arabian Sea or the Red Sea. I think these will be massive investment opportunities.
Permanent adjustments.
I believe so. I think, when you look at certain countries within the GCC that are completely dependent on the Strait of Hormuz, they've seen their oil exports collapse to 0 barrels.
the supply of critical food, materials, commodities became at risk. And so being completely dependent on one waterway that is now at a heightened risk of repeated closures, I think is an obvious non-starter going forward. And so creating these alternative routes will be critical.
Right.
So we're seeing that capital reshoring in preparation for these investment opportunities. We are seeing a tilt towards liquid asset classes because clients want to maintain the flexibility to be able to move as soon as these investment opportunities materialize. So that's the second thing we're seeing. The last thing I would highlight is we're seeing increased interest in private credit specifically. Given the massive flow of investments that we've seen in the region over the past few years, that has resulted in a significant uptick in demand for credit. And so availability of credit, speed of credit, and customization of credit structuring is critical, which has pushed borrowers to look beyond the traditional banking system into alternative forms of credit. And so when an asset class that has been practically dormant until very recently, now we've seen an explosion of both demand for private credit and supply of investors into the asset class.
No, thanks for that. That's really interesting. Before we go back to Elliot Hento's second video, which I'm going to play back, I do want to ask Mark Elliott a question about the US-Chinese relationship, US-China, one of the most important bilateral relationships in the world, which really affects trade, investment globally. So it's very important that we also examine and understand how that relationship is developing. Your institution, I think, is the only one in this room, at least today, that has, and correct me if I'm wrong, if anyone in the audience wants to raise their hand, but certainly MasterCard, the CEO of MasterCard joined President Trump's visit to China, his recent visit. We haven't heard too much about what was discussed, but I thought since you're here, we want to use this opportunity. If you can share with us what your CEO, Michael Miebach, whom I know, and give him my regards, please, what were the main takeaways from that visit? Anything you can share with this audience and our viewers on the live stream would be much appreciated.
Yeah, I mean, I think thank you for the question. I think the reality is that in a global company like ours, emboldening your footprint and your business in a country like China is critical to ensure that you've got a runway. And for many years, we didn't have that opportunity. We had a limited domestic presence. We got a license several years ago, which was really a game changer for our business, because it now means that we can process transactions locally and we can work and add value to consumers. So the visit really, for MasterCard and others, in many ways was about embracing those public-private partnerships. I think in a time like this, one needs to be cognizant that payments and many other aspects of what goes on in an economy on a domestic front become strategic domestic assets. And so we recognize that as a company, and we embrace that. And I think the way to embrace that is to respect sovereign, to understand sovereign, and then to collaborate and think through how do you work together so that you can bring through innovation, work through the ecosystem in those public-private partnerships. As an extension of that, I think amidst the geopolitical crisis, which we're all very aware of, I think EMEA has a critical role to play. Because as we see increasingly, it's almost like the nexus, it's the connector of trade flows globally. And I think that's on us. That's the responsibility that we have to think through how can we play into that. And I do believe that the institutions in this room are critical, and that's why we want to be working here, that's why we want to be here, is that commitment, that visible commitment to working with the institutions to provide that interconnection.
Thanks for that. Let's move now to the second video of Elia Tentov, our geopolitics expert. If you could please.
We hope that the main part of the war is over. So the question is, where do we go from here? Well, to be fair, there is a negative component. There will be a risk premium, a higher risk premium placed on Gulf assets. There's a chance of a renewed conflict down the road. Some of the fiscal profiles have deteriorated as a result of the war, and so that negative risk premium will be a cost. On the flip side, some of the response to the war will have to be higher investment in the domestic economies, in civilian infrastructure, in defense, and in resilience for future conflict. That investment requires a repurposing and flow through the capital markets, and that's also where the opportunity set lies in the Gulf.
You heard him. Where there's crisis, there can be opportunity. I think that's his main message. So yes, the conflict caused a big setback, generally speaking. However, some of those capital flows will necessarily have to remain within the GCC to enhance resiliency of the GCC and connectivity, interconnectivity, as Your Excellency mentioned, logistics, what have you. So will that have, I don't want to say unintended consequence, but the positive impact of maintaining and actually maybe even getting the capital markets to outperform in its previous years? Is this something that you see as a potential consequence and impact of that conflict?
Question to me?
Absolutely.
So I think building on what was discussed earlier in terms of sectoral focus and priorities, I think the shift going forward will be from the nice to haves to the must haves. And this goes back to connectivity in terms of energy and alternative export routes, utilities, supply chains. And I think what's worth highlighting here is, I think within that context, Oman is very well positioned to be a gateway for the region. I think Oman's strategic position and significant geographic location with direct access to the Arabian Sea is a unique value proposition for the region. It can be the gateway for trade flows in and out of the region, and therefore capital flows as well. And I think that's in addition to the strong fundamentals that Haytham referred to earlier in terms of fiscal discipline, which is quite outstanding in a world that is otherwise marked by significant government deficits. You're actually seeing surpluses, you're seeing continued reforms, diversification, growth momentum, a growing and deepening capital market. I think all of that is a favorable context, but then on top of that, you get this unique value proposition and positioning that I think can be a significant driver for investment opportunities in Oman specifically.
Brother Faisal, I would like to add to what Tariq has said and to comment on the video. Yes, there will be a premium. However, this region have a very deep pocket in terms of sovereigns as well as families and high net worth individuals. If you see this region is not very open, or they did not open still for private sector, so you see lots of hungry of capital that are willing to invest in this region. So I believe there it will be a very competitive market.
So there's still appetite,
I believe,
despite the risk premium.
That's correct. I think there is a huge appetite on GCC risk.
But first, if I may, is the risk premium justified?
What I say is there will be a premium. However, this premium will be elapsed within time. Once you see the demand that's coming from regional investors and then will follow by international investors. As my brother Tariq said, privatization in the region did not happen a very large scale. However, it was tested in areas in some countries where I believe there will be more capital demand for.
And this risk premium will slowly phase out as things stabilize. That's the
This is
forecast.
what I believe, as well as the competitive of capital to be deployed in this region.
Let's have a look at that. Go ahead,
And
sorry.
if I may add, I think also you'll see a bifurcation of risk premia. So I think international and regional investors price it differently. And I think this is where regional and domestic investors will have a competitive advantage in capturing these investment opportunities.
Regional and domestic more than international. Can we have a look at the graph just to also continue this discussion? And I would like to hear, Haytham, as well, your thoughts. But first we put on, there's a graph that I'd like to be displayed on the screen that I think illustrates as well how GCC equities performed over the past 5 years or so. This is a graph used by one of our very own Karine Khairallah, who works with SSIM. And it's a really great article. It's called The Path Ahead for GCC Equities. If anyone's interested, please approach me after the panel discussion, where she's looked at the performance of GCC equities, which is the yellow line, and compared it to a number of other asset classes. So US equities, emerging market, oil, and world ex-US. You will see that the GCC actually outperformed emerging markets and did relatively well, even towards the end of the time period under review. And this actually goes up until March 20, so a month into the beginning of the conflict, where there was a slight dip towards the end, but still managed to maintain, if you like, the overall trajectory. So what can we deduce from this graph in terms of the performance of GCC equities vis-a-vis other asset classes?
Okay, so basically, what we see in the graph, if you see the U.S. market as the top performer in terms of equity, majority of the well-performed U.S. stock was in the Magnificent Seven.
And what's right?
Magnificent Seven, and NVIDIA and the AI, which drove the market up. If you see on the traditional sort of economy or shares in that market, probably they are not as performing as the graph is showing. So relatively, what GCC is performing over that period where there is not much of an AI or huge companies that is related to the hype, I think the performance is relatively very well.
Yeah.
As explained by my brother Haytham, the region have still, they are just open for international investors to come and invest in, new ways of creating opportunities. Market became more transparent, so people have a better understanding.
And
this is reflected by the
completely.
graph.
And do you also see that there seems to be a decoupling from oil? So that green, you can turn the lights off. The green on the top is basically a representation of the performance of oil throughout that 5-year period. And you see when oil prices go up, GCC equities would also increase in value. And there's a correlation. But that correlation seems to have all but disappeared towards the later years, if you can see that. What's driving that?
I think maybe this is mainly driven by GCC is diversifying out from oil and gas, and this is where is the reflection, probably.
Okay.
It's a 5 years, I would say, story of the GCC, where most of the visions that has been followed has attracted investments all over to the Middle East and specifically to GCC.
Okay.
So Saudi 2030, Oman 2040, and so on. And that's why you can see that the growth in GCC is much higher than the others.
So is the diversification policies in place in the GCC countries, does that show that we're actually doing pretty well?
Yes.
Would you agree with that? Is that a representation that the diversification plans seem to have impacted positively the decoupling, as it seems, from the equities markets in the GCC from oil prices?
I think, to me, the most effective measure of diversification and reduced dependence on oil is not that, and it's also not what percentage of government revenue is oil, because if the non-oil revenue is primarily taxing an economy that is otherwise dependent on oil, then effectively you're still collecting oil revenue indirectly.
Okay.
I think the best measure of effective diversification from oil is percentage of exports of goods or services that are not oil or oil related.
Understood.
So in other words, how much of your dollar inflows into the economy are not linked to oil?
Right.
But just quickly commenting on this chart, I think there's an important point that can be easily missed when you look at this chart, which is, and I'll take the Saudi market as an example. If you look over the past 20 years, you'll see that the Saudi market, on average, delivered a return of about 6% compared to about 8% in the US. And so the obvious question is, then why invest in Saudi? If you have a deeper, more diversified market in the US that actually delivers a higher return, why would you invest in Saudi? And I think the same comment applies to the GCC as well. And the answer is actually in the potential for outperformance.
Okay.
So here we're looking at indices. In the US market, it's a market that's highly efficient, and therefore it's very difficult to consistently outperform the benchmark. Your best bet is to actually invest passively in the index.
Right.
Whereas in the GCC, the potential for outperformance and alpha generation is significant. So if you actually, in addition to plotting the GCC index, you plot the performance of investment managers in the GCC, you'll see a curve that looks significantly different from the line we see in front of us, which I think better presents the investment thesis in the region.
Understood.
Maybe I just wanted to add also another point here. I think we had a good time of access capital in the region, where basically also it was seen as cheap basically cost of capital, and that itself actually drove also tends to be not that much even attractive for international investors. I would see definitely what your colleague just mentioned, that the risk premium will come into the picture soon, especially on the short term, because this excess will not continue to be there. We will really allocate some of these investments into more long-term investments where pricing will be different. So I would assume, in the long term, to be competitive, to attract international investors, will need to be seen similar to emerging markets returns. Yeah. Otherwise, it's very difficult for us to continue investing our money, assuming that that will be sufficient for us to build our infrastructure and go forward. So pricing will need to be changed. It will need to be attractive enough for international investors to come along with us into making this story of developing the region. We have started the privatization. We did well. I mean, if I may refer even to the story we had here in Oman, when it comes to the privatization of the energy, the power sector, the first IPP we had in 1994. At that time, the pricing was really high for us to start any privatization program, but we had to start. Yeah. And since then, of course, the price went down, and now we have a very more competitive market. But also, lately we've seen it's changing, actually, again, because of access of capital, because of definitely cost of debt is also playing a role there. around 2 billion Oman Riyal, which is $2.5 billion. And he's talking about almost $500 million invested in SMEs. And I think on infrastructure, on the way forward, we do have the blueprint. All the countries work together over the last few years. They understand each country's kind of pros and cons. So working together, it just needs the acceleration now, I think. It needs the will to move forward in a faster pace and ability to basically build a stronger resilience that will allow us with the right framework, the right governance and regulatory to unlock the current value we have within the region. We have a huge potential in the region, and we are young in terms of population. We have, so ultimately the story is there. We have the money, we have the capital, we have the location, which is basically connecting the world. So I hope we can develop this further as soon as possible and take this into a stage where really we recover what we have lost in the last couple of months.
Thank you very much. This has been very insightful. I'm not even going to try to summarize what's been said today, but I think really some of the main takeaways, if I may, is that resilience is key. This is the theme of our conference, Oman Capital Market Conference, From Resilience to Growth. Resilience is something that is going to be required here on forward. It's not a temporary reaction to a prevailing situation, but rather the beginning, if you like, of something that will be building up in momentum as we go forward, and will factor into plans of businesses, asset managers, sovereigns, and governments. And so you've all, I think, done a fantastic job in sharing your insights, all within your respective fields of expertise, with all of us and those watching us on the live stream. The second takeaway, I believe, is that the GCC has done extremely well on the face of unprecedented challenges, and is very forward-looking, very forward-thinking, and working together as one cohesive unit. Because it's not only a question of we are stronger together. It's not a question only of this is something that we like to do. It's not a luxury, it's a necessity. And we are only stronger together, but we are operating as one cohesive and strong unit in the face of all the challenges we are seeing. And I think some of the graphs that we showed today clearly demonstrates that not only is there appetite for GCC assets, whether it's in the equity markets or others, but actually it's doing pretty well and performing surprisingly well, despite all of those challenges. So these are some of the main takeaways that I have taken away. I hope you enjoyed this as much as I have. This is the beginning of something, only the first Muscat Leadership Dialogue. If you liked it, hopefully we'll have another one with the blessing of our guest of honor and others. So please, after this is going to be a break. But do come back at 11 for the global energy debate, which is also a very exciting debate. And with that, I conclude the Muscat Leadership Dialogue. Please give a warm round of applause for our fantastic panelists.
Just please remain in place. Thank you very much, Faisal, and all of the speakers in the dialogue. Please do now take an opportunity to network and enjoy some coffee and snacks outside. I'll be a bit more lenient than Faisal. We have a little bit more time, so please return not at 11, but at 11:05, and for a very nice conversation on energy to follow. Please, delegates, please begin to return to the ballroom. We're going to begin in a minute. Would you kindly take your seats, return to the ballroom, and take your seats, please, so that we can begin. Please, if you would kindly return to your seats so that we can begin. Thank you. Thank you. Okay, we're going to be starting now. I would like to invite to the stage a very senior panel. And this panel will explore the ever-changing mosaic of energy, again, on a regional and global level with an Oman focus. Nemer Kanafani, a leading economist and energy expert, will lead the discussion. Can I ask Nemer and the energy panelists to come to the stage?
Hi, Ali. Good to meet you.
وين سيدي اسلم تفضل لك.
Nice to meet you. From Shell.
Over to you, Nemer.
Hi. How are you? I'm Zaki. Nice to meet you. How are you, Ali? Sorry. That way? Okay. Getting cozy? Yeah. Okay.
Good morning, everyone. Thank you for joining us. We look forward to having a rich conversation here. A fantastic panel lined up, talking about energy and trade. Indeed, a pleasure for me to welcome you to today's panel on energy and trade. I suppose we could hardly ask for less interesting environment for this debate. Lots going on. Even if you stretch back 3-4 months ago, we had plenty to talk about. Now we have even more things to delve into. For decades, businesses, investors, and policymakers operated under a set of assumptions that increasingly came to be taken for granted. Stable trade routes, expanding globalization, abundant energy supplies, and a gradual but predictable energy transition. In the past few years, many of those assumptions have been challenged. We've seen a resurgence in tariff policies, for example, industrial policies back on the front burner, growing geopolitical fragmentation, and more recently, the conflict which has disrupted trade through the Strait of Hormuz, one of the most important energy and trade routes. For the Gulf region, these developments are front and center. They directly affect energy exports, imports of goods, as well as services, investment decisions, and long-term development strategies. Hopefully today we'll delve down into these top headlines and give us a chance to delve deeper into the topics. At the same time, the energy transition itself appears to be entering a new phase. Support for net zero policies in some places around the world has waned, yet investment in renewable energy continues, and undoubtedly there's been already a transformation in cost and implementation. And at the same time, we have new sources of demand reshaping energy markets once again. Perhaps the key question today is whether we are witnessing a fundamental recalibration. And if so, what does it look like? This is hopefully what we'll shed light on here today. Are we moving from a world that prioritizes efficiency to one that emphasizes resilience, the word that we hear a lot about? Hopefully, we'll delve deeper into that word and to try to understand what it means in practice. From just in time to just in case, from optimizing costs to balancing costs, security, flexibility, and sustainability. And of course, we'll look at what that means for the GCC as a region at the intersection of global energy markets, trade flows, and investment capital. To help me explore these questions, I have a fantastic panel lined up. Mr. Ali Janabi brings some experience from one of the world's leading energy companies, country manager of Shell Oman. Zeki Sumar, Senior Vice President and Portfolio Manager at Vision Invest, has extensive experience in infrastructure development and strategic investment across the region. Mahmoud Leblouchi, Chief Commercial Officer of Oman LNG, brings direct insight into LNG markets, energy trade flows, and the challenges and opportunities facing exporters in today's environment. Azan Abdulatif, Chief Portfolio Officer at OQ, has extensive experience in the Oman energy sector and brings his perspective on energy investment and the evolving role of capital markets. And last but not least, Hassan Khouman, from macro strategists at BlackRock, will help us understand how global investors are interpreting the economic, geopolitical, and market implications of these developments. Thank you all for joining today. I'd like to start by asking each of you to take a step back and look at the big picture. How are these developments affecting your sector, and what other trends or forces do you think business leaders and policymakers should be paying close attention to in the months ahead? Mr. Ali Janabi, would you like to begin?
All right, let me try to kick it off. So first of all, assalamu alaikum, good morning, and a real pleasure to be invited here. And I thank Akhoy Faisal for the kind invitation to be with you and to be along the esteemed panel. Nimr, I think, so maybe let's take it from a macro picture and then bring it down to a local one. So from a macro picture, we look at the energy supplies as being key, of course, to growth, to development, and there's one direction where energy demand is heading. It's heading upwards with the increase in population, increase in demand for data centers, and so on and so on. So directionally, what really has happened, it meant that what we were on before, which is, let's say, call it the energy transition, is something that is playing out, and I think will continue to play out at a macro level. But the pace of it will continue to be different for different countries and different regions. And we've always said that all along at Shell, is that energy transition will be different for different sectors, but also different regions. What we also realize, as the result of the current shock to the energy supplies, is that there are more countries that are more resilient than others. And that resilience came through because they had storage, or they already had shifted to alternative forms of energy, and therefore they were able to play a bit of a balancing act. And you look at where China is and how much China consumes and how much China brings on stream in terms of renewables, it's actually significant amounts. It's what the total world brings on, they bring it down in 1 year. So there is some resilience. That said, we do see the curtailment of some 14 to 15 million barrels per day that is stuck on the other side of the Straits of Hormuz. Let's start with 20. And I think you've heard numbers with Saudi being able to bring the East-West pipeline, UAE is being able to bring additional incremental capacity through Fujairah, and a few vessels here and there are able to export, Iraq a little bit through Turkey. You're able to narrow this down to, let's say, the 15 million or so. What we are seeing today is that there is, in certain sectors and certain countries, a demand destruction. nothing new. We saw it during COVID. Yeah? Difficult to say how much it is, but probably around 4 million barrels or thereabouts is what we see in terms of demand destruction. And a lot of it is really linked to more of the other ends around the fact there's a big demand out of the Middle East into Asia, predominantly for petrochemicals. So that's the naphtha, the condensates, and the LPG. And we don't talk about that when we talk about oil. We only think about oil, but there's a lot more that is stuck at the other side of Strait of Hormuz. So then the question is, the so what? It really is a function of two things. One is how long this is going to remain with us. And so we look at it maybe in 3 or 4 different lenses. A lens that says, how long is this elastic going to run? And will it be able to go back once things resume and the Gulf reopens? The Strait of Hormuz opens up? Question. 6 months, 9 months down the line, it will look very different to 3 months. And we're only about 3 months, by the way. If you really think about what we've been going through, we're only in the 3rd month. Huh? Then there's the other part, which is there's a different view on the Straits of Hormuz in terms of the risk. The genie's out of the box. Everybody thought that there will always be a risk, and it was kept in back of people's minds. That risk has emerged, that there is one day could be an interruption. So you will see a different view on how the Gulf as an energy supply will be looked at. And therefore, there probably will be a different requirements of how to give a bit of a comfort. Therefore, the second part is, I talked about there's the energy transition. The second part is the security of supply. That's going to be a fundamental key question that countries, sectors will need to grapple with. Third one is the point of affordability. We saw, and I'm going to jump into your patch, Akhi Mahmoud, because you have done a phenomenal job as Oman LNG, making sure that the energy supplies is continuing, despite some serious challenges to the sector, namely around shortages of vessels being available, the insurance market, the availability of crew, and of course you've done a phenomenal job in making sure that your customers are supplied. So hats off to Oman LNG for this. But this all comes at a cost. And then the question is, can we have a reliable energy supply that is affordable and that is secure? And so therefore then you look at, well, what does this really mean? It probably means the just-in-time mode that you talked about earlier in your opening remarks, the just-in-time, the Toyota way of getting supplies in and getting your energy in is no longer going to be as applicable going forward as it was before. Then the third one is that in order for us, we forget that the oil and gas fields have a natural decline. And with a natural decline means in order for it to keep it constant, you have to continue to invest. That investment is going to become a lot more costly because supply chains are broken. And once we resume, and obviously we don't know the extent of damage in some of the countries that have been impacted, there's going to be a huge call on contractors and vendors, and it's just about catching to the queue. And we always have these conversations here, so what does it mean for us in Oman? In terms of how do you continue to, you've had a business plan and you had a forecast for how much capex you need. The question is, where does that capex get prioritized? Yeah, and of course, when we talk about Shell as a global company, we also have to look at where does that capital gets prioritized as well, based on where the requirements are. And then the last one I'm going to reference to is that resilience, bringing it back to you, what you said. Resilience is not just about a single supply from a single source. I think we're starting to see a reshuffling of relationships, a rekindling of relationships, and probably you hear about new pathways for pipelines, and you said new pathways of supplies that were probably not heard of before, supplying from the US all the way to China. Yeah. These are rekindling. The question is, are these price sensitive? And if they're price sensitive, how likely they're going to continue? And if they're not price sensitive and it's just purely for supply, security of supply, insurance, same as the way that you pay today as an insurance to get supplies from the GCC, is that insurance premium is going to continue or not. I'll just reference
Okay.
it from the background.
Thank you. Thank you, Ali. Maybe I'll move to Mr. Azan. If you could shed some light on your thinking in terms of how this current environment is changing.
I echo a lot of Ali's comments. I think it's a big structural shift that we are witnessing, and a complex one, at sake. And yet we are yet to, have a vision on where this all lands. But of course, we are moving away from, competitiveness of cost to what gives you the competitive advantages is the reliability and the resilience of providing energy. We're used to, at least in the region, competing on cost of cheapest barrels, etc. So I think that was our previous competitive advantage. I think the market rewards players that are reliable, have a reliable source of energy, consistent, and at a competitive cost. Maybe there is a premium for that resilience that we are to see as well. That's more or less on the macro level. I think Oman, as its geographical location, is a resilience asset that should be capitalized on, but there's a window for that opportunity as well. Because there will be a balance between resilience and efficiency.
Okay, thank you. Mr. Mahmoud, maybe you could shed some light from your perspective on how these questions are helping you think about resilience and.
Sure. Assalamu alaikum. I think the region has always been a reliable supplier. If you like, in the past 3 or 4 decades, especially since LNG export and oil export, of course, from the region. The region is well known to be a reliable, prudent supplier. And that's the key, I think, going forward, how to maintain that reliability of supply, how to maintain that flexibility. At the end of the day, what matters to consumers is security of supply. Yeah? Including today, for example, we, Oman, alhamdulillah, continue to export. But there is a lot of question mark from consumers, whether that security of supply is there. Will there be any development that hinder Oman from being from continuing to supplying LNG or oil or other energy to not being able to supply? That's a key for the region. I think in the earlier session there was discussion that some countries, alhamdulillah, managed to diversify from their different outlets. I think this needs to be increased. Today, when we talk about some outlet in the Red Sea, Oman as an outlet, but there are still a lot of concerns for a lot of consumers out there. Some consumers, they are lucky to have alternative energy supply like coal, like nuclear, but other consumers, they don't have that leverage, they don't have that luxury. And I think for us, going forward as a region, we need to maintain, we need to give assurance for the consumers out there that we continue to be a reliable supplier. Yeah? And how that can be done, of course, by building multiple corridors across all the region. We need to complement each other in doing that. Oman itself cannot do that, Saudi itself cannot do that, UAE, Qatar, Kuwait, Bahrain, we cannot do it independently. I think we all need to complement each other, build that corridor so that we regain the reliability of supply status with the consumers.
Thank you. Zaki Somar, maybe we'll move to you. There's a lot of talk about resilience, and infrastructure is a big part of the picture. Maybe you can shed some light on those topics.
Thank you, Nimr. Thank you, Faisal, for the kind invitation. It's a real honor to be sharing the stage with such industry leaders. Look, Nimr, I think the energy debate has changed fundamentally, right? I think everyone would agree 5 years ago we spent most of our time talking about decarbonization, as a key trend in energy. I think 6 months ago we were talking about energy security, energy efficiency. I think today the debate is about energy efficiency, energy security, access, infrastructure resilience, and decarbonization all at the same time. And I think that's what's different today, and that's what's changed in the last kind of 2 to 3 months, is that we have to have a significant push, not just in access to energy and efficiency of energy, but also the infrastructure surrounding it. And the reason I say that is the perspective is that I believe that energy has to be looked at as an ecosystem and not just access to molecules. Because the access to molecules, as you talked about, Ali, is just one dimension. If you can't move those molecules around, the energy access is insufficient. And that's where, our perspective at Vision as an infrastructure investor, developer in Saudi, the way we're really looking at this, and it was much to the dialogue earlier in the roundtable, that where there is crisis, there is opportunity. And we do see opportunity. We see opportunity in better interconnectedness between the GCC states when it comes to critical infrastructure. We see opportunity in advancing renewables in a way that it's not just about energy transition, but actually it's about energy security. And we see opportunity in capital flows. Tariq at Jadwa on the earlier roundtable mentioned that certain foreign investors might be priced out because of the risk premia they apply to investment in the GCC. Whilst I completely agree, and that certainly will be the case, I think that presents an opportunity for local and regional investors. I think it's no coincidence that we're having this debate in Oman. I think the importance, the significance of Oman from an infrastructure, strategic infrastructure perspective is unparalleled. And I think that we will continue to see the benefits of that, and hopefully, inshallah, Oman also sees the benefits of that.
Thank you. Mr. Hassan, maybe you could shed some light on your perspective on the global trends.
Yeah, thanks, Nimr, and I think very good morning, everyone. I think it's good to always go at the end because then you can try and connect the dots with everyone in the from the esteemed panel. So look, I mean, maybe just starting off high level from a global perspective in terms of how we're seeing it from a macro perspective, and then kind of drilling it down to the region. Look, at BlackRock, I think the common denominator that we've been saying within us for many, many months, that it's a world shaped by supply. This is all about the mega forces of geopolitical fragmentation. You've got the AI build out, and you've got the low carbon transition. For us, that's all coming together. And I think the region, the conflict that we've had, it only supercharges those forces. And when you look at what that could cause from a global perspective is structurally higher inflation, more macro volatility, and you've got a portfolio construction that needs to manage that from an investor perspective. And so in this world-shaped supply, we kind of drill down and see, what's the next phase? And I think, we heard from across the panel regarding the security of supply. And I think that's going to be an increasing theme where I think, markets don't just value energy supply, but they value the security of supply. And you take countries within Asia that have been heavily linked to Hormuz-linked traffic. You take Taiwan, you take South Korea, you take India, you take Pakistan, you take the rest. They all now need to face their reaction function about how do they handle resiliency, how do they handle reliability in this new environment. And so for that, I think for us, when you are an exporter, say Oman or others around the world that are not exposed to major choke points, say Australia or say parts of Latin America, you're going to start commanding a growing security premium. You're going to start adding that premium onto your supply. And I think that's a story about market concentration. And we drill down a little bit further and say, okay, what's been the root cause of this? And we think that it's not just the source of energy, but it's actually years of underinvestment. The hydrocarbon sector has had many, many years of underinvestment. We've heard the IEA speak about it, the EIA, others. And now you've got the old economy underinvestment, and now you've got this new economy, AI-led, data-driven electrification, data centers, that's adding a new wave of supply constraints. And so we think with this old economy underinvestment, you've got a new economy now supercharging the next wave of supply. What does that mean for macro? And ultimately, we think that means structurally higher inflation, and that means a much more volatile environment. And so it leads to the policy question. You know, the region is pegged to the dollar. It follows the US Federal Reserve in terms of what it does. And so we think that we are moving from a pre-COVID low rates environment to a now much more structurally higher inflation, much more higher for longer interest rates environment. So the hurdle rates for projects will start increasing simply because we think that it's going to be a much more interest rate prone environment. And so with that, we think about the investment opportunities. We think, what does that mean from an investment perspective, right, for the region? And I think it comes down to, you know, when we look at energy, for many, many years, it's been seen as a cyclical asset, as part of a commodity asset class. If we're dealing for a higher for longer, you know, supply constrained environment, you expect higher for longer prices. And for higher for longer prices, that means that we think investors will start shifting the way they perceive energy as an investment vehicle from a cyclical asset to actually a more resilient asset. So we think, in fact, we could see much more investment in the energy space to kind of compensate for that years of underinvestment we've had. And so, you know, when you look at the shares of energy in total market share for, say, the S&P 500 or parts of Europe and so on, it's very, very small. And we think that would only increase in the years ahead simply because of the underinvestment. And now you have this new economy wave of AI that will need to see much more energy. So we see a much more bigger share of investments coming through from an investment perspective.
Thank you. Very, very insightful. Excellent. I'd like to shift gears a little bit. Maybe with you, Ali, if I could explore an area which a little bit on the side, which is innovation. And I'd like to really look forward and see how we can innovate ourselves out of some of these constraints that we have, we're living with. Are there interesting areas in innovation that you think are really going to be offer potential? Where does and if not, is the landscape a positive one? And where do we stand right now?
So innovation, the purpose of innovation is to do two things. One is to improve your efficiency, and at the end, of course, have a better financial gain, all right? And so as Shell will continue to put all our funds into a significant amount of research and development, but we've been probably one of the largest from across the patch of international oil or energy companies, as we call ourselves now, to in terms of that investment. We see fruits from that coming through. Innovation has to be there in terms of managing the declines, the underinvestment that you've referenced there, Hassan, which is, we've got declines, natural declines in fields. And the question is, how to ensure that that base production is sustained? That requires a lot of innovation. So there's a lot of it to do with subsurface related, enhanced oil recovery, secondary, tertiary, and so on. Don't know what the details of that here. Then there is the bigger picture of, well, can I do a lot better with my seismic interpretation, the subsurface? And there's a lot of AI that is brought into this to say we sit on a lot of data, and basically we've only seeing a benefit of a fraction of that. And with the amount of computing that is coming in, we're able to do a lot more. And we've got a couple of programs that have just been rolled out within Shell to basically pull all of that data and look at a better simulation of the data base of subsurface, a better understanding of the subsurface, and we've seen successes in that. That's the subsurface part. Then the question then becomes is, what else can you do in terms of just innovation and efficiencies? We're seeing, again, a lot of what we do in the office. Maybe it's the boring stuff, but it is, how do I get efficiencies out of people's time, my time, and others who are in the office? Yes, that is being worked through. Yes, we're using a lot more of the AI Copilot. What does that do? We're just touching the surface as an energy sector. I know that the tech sector is leaps ahead of us, and we've got so much to learn from them. But we are. And if anything, within our executive kind of focus within Shell is we're embedding that you and I must ensure that we do embed AI into our daily operations. But the third one is there's a lot that happens in terms of the ability to move molecules. And that goes into the the trading platforms and into, so if you remember a couple of years back, everyone was talking about blockchain. And it was the biggest, starting with blockchain and how do you build on that to ensure that transactions do happen, there's transparency around it, then there is also ability for you to be able to locate the transaction and able to locate molecules and origins. There's a lot that is happening on the blockchain on the trading side. But then you go to the last one, which is around the ability for us to start integrating cross platforms. How do I integrate renewables with the traditional energy? That doesn't happen just like that, and especially when you start looking at utilities. We've seen some blackouts in Europe, a couple of, it was last year or the year before, yeah? If you don't integrate your renewables with your base loads, you are going to get some serious trips. And we get that series of trips, the whole country goes into a blackout. So there's a lot of innovation, a lot of data that goes into it, making sure that even that fraction of a millisecond interruption into your electricity supply is actually immediately addressed. So these are just kind of pockets of where we do. We invest heavily, and not only just Shell-owned research and development, but we actually are quite active in a lot of, through Shell Ventures, where we do invest in tech companies that simplify the frontline work for work done to, the data analytics part. And this is in collaboration with a number of the financial institutions as well, but also looking at with the VC. And I know there's a number of VC companies here who also do quite a lot. Yeah.
Thank you. Zaki, I'm going to move to you. If we can talk about, again, infrastructure. And, as an economist, usually it's easy to shoot down an idea. Everybody's now talking about flexibility of trade. And the question is, if we can really get increased flexibility, we could have already gotten there. So is this a matter of really paying premium for more flexibility, for more what some people are calling redundancies? And does that actually make sense at the boardroom in 3 months' time or in 6 months' time to really pour money into pipelines that are redundant? Let's say when the crisis is over and we're back to normal. How do you see those things playing out? And how do we kind of have a consistent long-term story that doesn't just fizzle out when the conditions change again?
Sure. No, it's very topical, Nemr, because this is exactly what we see is playing out in boardrooms, in investment committees, for infrastructure developers and investors like us, not just on the back of this crisis, but even prior. The thing I'll say about investing in infrastructure resilience and security is that it's only good if you've invested in advance of a crisis. Post-crisis, it becomes slightly sort of counterintuitive or even reactive. However, where you do have infrastructure security, it addresses choke points, right? So in the absence of investing in critical infrastructure, you create choke points. And we've seen this now play out in the last 2 to 3 months. With critical infrastructure investment, it creates stability. And I think everyone, when we talk about infrastructure redundancy, we now realize, and I'll give you a real life example, this was mentioned earlier, but had the east to west pipeline in Saudi not existed, the world, not just Saudi, but the world would have been 7 million barrels of oil per day short. It's hard to put a price to that. There is an oil price per barrel, and you can price it. But the fact is, that created a choke point, and it is that infrastructure, that east to west pipeline, that allowed for, even in those conditions, for oil to move. So the way we're looking at this as an infrastructure investor is actually the rerouting of capital flows into critical infrastructure with partners, international partners, the likes of BlackRock, where we're saying that actually looking at the infrastructure asset class is not just about critical infrastructure and infrastructure security, but it's actually maybe a way for a global hedge to the portfolio of these institutional investors. Because in the absence of investing in that critical infrastructure, you expose yourself, and we've seen this now, globally expose yourself to vulnerability across portfolios. His Excellency Munir in the earlier roundtable mentioned that pricing will need to follow. Pricing from procurers, we see, will need to follow. A different perspective from international institutional investors will need to be taken to the region because of the point I mentioned earlier around it being a global hedge and not just an asset class, but actually it's essential to the security of their kind of global portfolio. These things, when you bring them all together, that is creating actually an opportunity that we haven't seen before in terms of redirecting capital, redirecting investment in critical infrastructure. And I think that's going to be hugely important.
Excellent, thank you.
I think maybe just to build on that, I think with as investors in, let's say, the upstream, unless you see a line of path to market, the continuity of that investment is not going to continue, right? So you cannot continue to produce 15 or to 20 million barrels from the region if there isn't really a certainty on where the molecules are going to go. So I think I very much echo what you were mentioning there, Zaki, is there will have to be some form of changes to how the infrastructure is looked at. And I know there's a lot of great work that Oman is doing in terms of being a conduit on the logistics side. And I think full credits to Oman for helping the region. In fact, I was across the border and very much look at how much trucks are going through on both directions. And full credit, had it not been for Oman, we would have been stuck as an industry, stuck as a region. So I think most likely is that you will start seeing some ideas that probably were shelved before may come to the forefront, maybe a bit more with maybe perhaps different forms of interests behind it.
I think if I can add on the LNG front, definitely one of the key principles of LNG long-term contracts is flexibilities.
Yeah.
How do you provide that flexibility, whether it's operational flexibility, whether it is destination flexibility, whether it is sourced flexibility, all of these play an integral part. A lot of the consumers, a lot of the countries, when they do plan for the energy source, they also cater for these seasonalities. And only by providing flexibilities, they can manage these ups and downs in seasonalities. So definitely one of the key principles in this agreement is flexibilities. Oman LNG is very well known for providing that flexibility to a certain level, as long as we are not, of course, damaging our own flexibilities. But I think over the past years, and I think it will continue going forward, flexibility is key item. Providing that flexibility, that assurance of flexibility to consumers is a key item.
Excellent. Thank you. That's very insightful. If I could stay on the resilience question, there really is an aspect of resilience is about resisting the shock and absorbing the shock, right? There's also a transformative aspect in which you find opportunity in a shock. So maybe that's something can also address the issue of the fuel mix, energy mix that comes into question. Is it an opportunity to kind of rethink some of those. Mr. Azan, would you like to shed some light on that?
Well, definitely it will reshape how we think of the energy mix. For example, renewables, we were chasing renewables to be cost competitive with hydrocarbons. I think the question of renewables now is not just purely commercial. It is of energy security nature that what is the right balance, what's the right mix. Brings back to light potentially hydrogen. Oman is betting big on hydrogen for the future and positioning itself. There's been a slowdown the recent past. I think this will get people to rethink how markets can evolve from a hydrogen perspective. So all in all, yes, there's the dynamics of the energy mix, the cost competitiveness, the security aspect, the reliability, resilience aspect will all come into play.
Okay, excellent.
Maybe can I just add on that? I think,
sorry,
just to build on what Azan was saying, I think you're up. There's a couple of things with regards to the resilience and the energy transition. We're all bound by a directive towards emissions reduction. The world needs more energy. We have to provide it, but we have to provide it responsibly, and we have to provide it with the lowest emissions possible. Where the difficulty has been is a couple of shocks have come into the system, namely the Russia-Ukraine, that threw a bit of the agenda that was heading in terms of policy making. And I think that's probably one that we say you can set a policy ambition, but it is really then you need to go to the next level. And we've seen that issue play out in Europe. There was a lot of ambition that was there, which meant places like here, which we are, obviously pursuing a project on hydrogen, meant that we needed to see, is there really a demand that Europe talks about? And are they really willing to fundamentally support that resilience and the security of supply that is required? Expecting to pay the same as what you're paying for gas, natural gas today, or let's say liquid fuels today in Europe, but yet expecting renewables, especially from a supply chain that is yet to be fully tested, hydrogen, and in its green form, is going to be very, very difficult. It's going to come at a cost. And I think that is probably one area that we look to policymakers. I mean, you talk about, for example, last year, we're expecting the IMO, the International Maritime Organization, to come up with certain directives on the ability to use, for example, ammonia and green ammonia. And that didn't come through. If anything, it got pushed. So I think it's that type of policy setting that has to come in and supplement major investments that are in the making. I mean, we as Shell probably have the largest at-scale hydrogen plant that sits in the Netherlands, Holland Hydrogen 1, for those who have seen it. And I know there was a conference in the Netherlands 2 weeks ago. What we initially set out for that to do versus what it is doing now is two different things, because the policymakers and the pull on demand disappeared. We were just lucky that we were able to push volumes and molecules to our own captive demand. 200 megawatts worth of green hydrogen, largest scale at the moment. Yeah, you put that investment, you can't put that type of investment and hope for the best. You have to put that investment on the basis of a predication that there will be a policy, there will be a pull on demand, and there will be the affordability on the other side to cater for that market. So I think the two have to happen together. It's not just about allocating capital, it's capital and policy have to come together.
Yeah, thank you. Yeah. That's very interesting. Mr. Hassan, maybe I can move to you to talk a bit about cost of capital and the premium on investing in the region, maybe. Are we seeing, the obvious answer might be that, it's going to be more risky to invest in this region. But it's probably not that simple, so maybe you could shed some light on that.
Yeah, sure. And I'm just going to pick up on what Ali just mentioned regarding sort of like, the amount of investment that's needed. And if we take a step back and if we were sort of, what I was saying earlier about sort of, a world shaped by supply, I think it's an everything above approach. Given the sheer velocity of the underinvestment we've seen in the old economy, hydrocarbon, grids, transmission, storage, now you've got this whole new economy, AI-led data centers, electrification. We need an all above approach in our view. And so that just means that we're just short of supply. And so in that environment, if we are assuming a more inflationary, a more higher interest rate environment, then the hurdle rate for projects will start to rise. And so the question becomes, for the region, if we are in a very capital intensive phase of the next phase of say 5-10 years forward, not just energy, but beyond, right? From a nation building perspective, the question becomes, from a investor perspective, how do they look at CapEx? I mean, there's only so much that the public sector can really absorb. And so we are increasingly seeing, and we think the next phase of growth could come from the private sector, right? And I think private sector equity and debt financing is something that we could see much more of in the region in the next 3-5 years forward. And we've seen very successful projects here in Oman linked to the solar projects. And if anything, as Ali was just mentioning regarding, say, the hydrogen space and other renewables, if they start to accelerate, then we think the private sector will be needed. In fact, it's definitely needed, given the sheer demand that's expected to come. I would say, renewables, we'll see if that demand comes through and so on in specific things like hydrogen that Ali mentioned. But I think certainly when you look at the CapEx numbers for, say, the AI data center build out, that requires investment and requires a large amount of investment. And we think simply that the private sector won't be able to absorb as much. And so increasingly we'll start seeing much more structured finance around the private sector, around equity, around debt. And we think that's going to be a major theme in terms of the composition of financing going forward, simply because of the infrastructure build out is just too large.
I think, Nemr, if I may, I just want to touch on what Essen mentioned, because I think it's quite important. I think what we're going to see, and we are seeing, is the lines between renewable and alternatives with conventional being blurred. And I'll give you an example of that. We've seen the jet fuel crisis play out in the last couple of months. We took the view at Vision about 6 months ago to invest in sustainable aviation fuel. It is shocking to us that actually sustainable aviation fuel production in the Middle East does not currently exist, despite the demand and the regulation in the EU that is driving it. So the way we're actually seeing, and this is, by the way, with a full offtake from Shell. So the approach that the big oil majors are taking is that they want to be asset light. They want to focus on trading the molecules. That's where it enables the private sector to come in and create, those investment opportunities where you can actually invest ahead of the curve. Yes, you will need to price in some risk. You can de-risk through offtake arrangements, which we've seen. But that's where the line between renewable and traditional gets blurred. We now look at sustainable aviation fuel, which we will produce from used cooking oil, as not so much energy transition, but actually energy security. Because that jet fuel or that aviation fuel that we produce now, every molecule goes towards addressing the very, very critical jet fuel shortage that we've seen pan out.
Excellent. Yeah, sometimes you need a crisis to shake up the system a bit.
Exactly.
And find new opportunities, new innovations that fill in the... I think that we maybe are in time to start wrapping up, so maybe we'll have one last chance for you to talk about something that you think you haven't mentioned yet that you think is important. It should be top of agenda for everybody. Maybe we can start with you, Mr. Mahmoud.
I think today when we look at energy, we were talking about renewables. We talk about sometimes in the past about nuclear, about gas, about oil. The key factor, I think, is that these energy sources, they complement each other. Sometimes we think they compete each other, but then I think in crises like this, we see countries surviving because they have the ability to change to alternative fuels. They have the ability to mix. And we see it in the LNG. Today, for example, at current level of prices, we see some demand destruction because simply some countries, big consumers, they are able to switch the fuel. And I think that will remain in the future despite the attempts, the tries to change to better, cleaner fuel. Looking at what is happening today, I think some countries will continue to have that mix of energy in their portfolio.
Yeah. What about you, Mr. Hassan?
Well, I'd like to link the discussion to the venue, I mean, the topic of this venue, which is capital markets, and aspiration to let our capital markets deepen in the sense of the multiple opportunities that have been discussed in terms of, like greenfield IPOs to access capital. You have, all this data center requirements with captive power around the clock. These are all opportunities, to utilize Oman's capital markets and the growth trajectory to, access funds, bring exciting stories to investors, and ensure that the growth trajectory is sustainable.
Yes, I think that's a very appropriate message. Capital market deepening is something we will all work towards, maybe a long-term goal. Zaki, any last thoughts you would like to leave everybody?
Look, maybe slightly selfishly, but I think the importance of investing in critical infrastructure cannot be overemphasized. We've all seen the risk of not having that critical infrastructure in place. But I think the one thing we keep thinking about is the role of GCC. And we're here in Oman. We've talked about the strategic benefits of being in Oman, what Oman can enable from an interconnectedness perspective when it comes to infrastructure, I think is hugely beneficial. I think the other thing that we keep saying or keep seeing as GCC is the east to west corridor, but I think we should not forget about the north to south. I think Oman also strategically, historically, has very strong ties with the African continent, in particular East Africa. That importance and that significance shouldn't be underestimated, because not only will Africa be a net consumer of energy going forwards, but actually the access it brings for things like critical minerals. And I take the opportunity of the fact that we have His Excellency, the Minister of both Energy and Minerals here. But the access to critical minerals is going to be hugely important. And it goes down to enabling supply chain, enabling trading routes, not just between and amongst the GCC, but actually globally. And for that, you have to broaden the lens of infrastructure, not just look at critical infrastructure to move energy and molecules, but actually look at things like ports and look at things like terminals and bunkering, to actually enable that movement of energy.
Okay, interesting. Ahsan, maybe you can go next with some final thoughts.
Yeah, sure. I'm going to be very glass half full. I think, the region, we've just had the largest volumetric shock in the history of, supply, right? Taken off the markets. And when you look at what's happened in the region, it's come out of this with remarkable strength. I mean, beyond Oman, I think every GCC country, when you look at it, no rating downgrades, remarkable strength from a sovereign perspective, from a financing perspective. They've diversified their funding channels. We had about $13 billion of private placements post-conflict because, of course, the syndicated market was closed. And since last few weeks, we've had a few stellar deals oversubscribed by investors. So we're very, very optimistic that even though we've had the largest volumetric shock in the history, of around, beyond crude oil, we've had a number of other, commodities that have been restricted because of the closure or the effective de facto closure of the Strait of Hormuz. It's still remarkable. And for us, that really does demonstrate a lot of resilience. And, the global economy was looking at the region from an energy perspective. But even so, I mean, we've had all parts of the ecosystem really come together and to demonstrate from policymakers, from corporates, from investors, they really do demonstrate that this is for a long-term thing. And we're very, very optimistic at BlackRock for the next 3-5 years forward, what the region can deliver beyond our esteemed panelists in terms of all their parts of the business, but just generally. And I think one of the things that we're really excited about for our region, and it kind of speaks a lot about energy, but it's really around the digital infrastructure and the AI build out for the region. I think that is going to be something we think in the next 3-5 years forward could be something incredibly important for the energy sector in the region beyond standard hydrocarbon and petrochemicals for downstream, midstream use.
Thank you. You're talking about resilience of the region. It brings to mind for me something. I feel like resilience is in the DNA of this region. I mean, the people forget. We invented geopolitical risk. And as an economist, I didn't publish a single report without talking about geopolitical risk and the uncertainty that oftentimes was just so far in the background, but it was there. Ali, maybe you can have the final word.
Geopolitics?
No.
I'll try to stay away from that. But look, I mean, so two parts. One is Shell in Oman. We have a mini Shell, and really truly privileged and honored for us to be able to be a partner of Oman for such a long time and continue to be. And that's everything from the molecule all the way to the end consumer that you'll see in the petrol stations, but also in Oman LNG, in PDO, which we didn't really talk much about. But a lot of the volumes that come out of Oman is volumes from PDO. And a lot of the innovation that we need to continue to inject, PDO is doing it. We are there as a partner to support, but they're doing a remarkable job. So that sustaining the supply today is key. The growth is coming. That will be key. As Shell, we're also probably one of the few, if not the only company that is present between here and Baghdad across all the countries. And so therefore, we have been stepping in and supporting countries and looking at, let's not forget the inter-regional demand for energy that is needed. That continues as a flow. So whilst the energy out is not, the energy in continues. Definitely the need for infrastructure is there. I think there's a lot of countries that are rethinking their infrastructure requirements and not to basically only put one hedge or one bet on one outlet. So I think there probably will be movement on that part. But the fundamental question will continue to be in the back of people's minds is, we have an energy shock now. How we're going to come out of this energy shock is still uncertain. We still have inflation ahead of us. Inflation is not just about the oil or the gas. There's the fertilizer, there's the food, there's a whole host of inflationary pressures that are coming. What is the impact of that? How much can the continuity of oil and gas as it stands today, without somebody then turning a different switch on and says, you know what, let's go back to the policy making of the energy transition and looking at carbon reduction. That will come sooner than later. It's not going away. It will come, and the question is when. And so the tricky bit that will continue to be is, how do you balance the energy requirements of today and the future with making sure that you have a resilient portfolio as a company, as investors. You have a resilient portfolio across regions, but also across sectors. The old economy, or the fundamental base load of hydrocarbons, but not just only about hydrocarbons, also looking at renewables. Yeah.
Excellent.
I think the upside of all of this, Nemr, is given the opportunity, we know BlackRock will now lower the risk premium for GCC deals.
Excellent. Thank you so much, gentlemen. It's been truly an honor and a very insightful conversation. I hope everybody also enjoyed this chance to peek at the deeper roots of what everybody's talking about and will be talking about for a while. So
Thank you again.
Thank you.
Thank you.
Thank you, Nimr. Thank you, esteemed panelists. Before we proceed with the program and the final panel, I'd just like to take a moment and step back and tell you a bit about our association and its role and activities. The Gulf Capital Market Association is the financial industry membership body that speaks with a single voice for the region's capital market and plays a leading role on all matters concerning development of capital markets in the region. The association is a licensed nonprofit organization guided by a regional board of directors that provides strategic direction. It's currently chaired by Standard Chartered Bank and co-chaired by Kuwait Financial Center Markaz. Previous chairs have come from S&P, from First Abu Dhabi Bank, HSBC, and BNY Mellon. Founded in 2010, the association harnesses the energy of its 90 member firms to strengthen capital markets. And our philosophy is that the capital markets themselves are a piece of critical national infrastructure, as much as any physical infrastructure. GCMA member firms are leading issuers, asset managers, banks, investors, rating agencies, legal advisors, and market infrastructure providers from the Gulf countries, as well as from other international financial centers that are operating in the region. If your firm is not yet a member, please do get in touch, and we'll share information on the benefits of membership. We work with governments, with central banks and regulators to strengthen markets. We have committees, chapters, and working groups that gather our members around key issues in Islamic finance, fintech, infrastructure finance, investor relations, securitization, derivatives, and sustainable investing. We set market practice and facilitate communication with the global financial community and raise awareness of the markets in the region. 3 years ago, the association established a special asset management chapter to represent the buy side of the market. It now consists of over 30 of the largest global asset managers, as well as important regional firms with a combined assets altogether of $30 trillion. This chapter has proven very effective in promoting growth of the asset management industry by encouraging best practice and engaging constructively with regulators. We would welcome the participation of Oman asset managers in the forum and are confident that together we can promote further development of the investment industry here in the Sultanate. One example I'd like just to cite of our advocacy in recent years and more recently in these months is working closely with authorities in the region on the transformation of the end of service benefit, which non-citizen employees are eligible for. Many of us are. But this is an unfunded liability that remains on company balance sheets. And we have been helping to design a transformation towards funded defined contribution schemes, which protect not only employees but also employers, and can also stimulate, as a result, the development of the asset management industry and develop further pools of domestic capital to support debt and equity capital markets. Each country will find its way forward, of course, but there's a lot of global experience that can be brought to bear. Anyway, how does today's event fit within the association's market building activities? We've been honored to work with our valued member State Street and the Exchange to create an impactful agenda and gather speakers to shed light on well-deserved accomplishments of the Oman market. But even more importantly, it's about plotting the way forward and navigating steps to deepen the debt and equity markets that support the transformation and diversification of the economy. So with this in mind, we have convened roundtables and held dialogues to develop recommendations and market practices for further development of the market here. And these will be captured in an industry white paper that will be completed and shared in a constructive spirit with the relevant authorities. It's well known and it's been discussed that the Oman market has demonstrated remarkable growth in recent years and has outperformed peers in the GCC and beyond. And as the Sultanate moves closer to a potential upgrade by MSCI to emerging market status, a question arises. Does this mark an endpoint or a new phase in market development? So next this morning, a group of industry experts will explore this and other questions in depth. So with that, I'd like to invite to the stage our final panel, which will be led by State Street's George Hanna and an esteemed panel of very distinguished speakers. George and speakers, please do come to the stage. I think they're being mic'd up. Okay. Okay. Can we secure our panel? Okay, welcome, please. Thank you. Please just go ahead and take the stage.